All right, good to see everyone. We are here to talk about the future, and something massive just started happening that most of the world has not even noticed yet. It is a trend that has been quietly building, a series of tremors before the earthquake. And if you are in this room, you are one of the few who gets to see it coming. For the last few years, the big story in corporate adoption of crypto was simple. MicroStrategy buys Bitcoin. That was it. That was the whole story. The thesis was digital gold, a passive hedge against inflation, a very large, very inert digital pet rock. You buy it, you stick it in the vault with a company like Coinbase, and you hope to God that the price goes up. But that story is over. That was Act 1. We are now living in Act 2, and the plot has completely changed. We are witnessing the beginning of the great corporate treasury rotation, a strategic, coordinated pivot by publicly traded companies away from the passive gold thesis and toward a new active infrastructure thesis. And the target of this rotation is Ethereum. Let's just run through the numbers so you understand the sheer scale of what is happening. First, we have a company called SharpLink Gaming, a publicly listed online marketing company. They just raised $425 million in a private placement led by none other than Consensus. That's Joseph Lubin's company, one of the original co-founders of Ethereum, and their goal to make Ethereum their primary treasury reserve asset. As of the start of this month, July, their treasury holds just under 200,000 Ethereum. At today's prices, that's about $500 million. And Joseph Lubin himself has joined their board as chairman. Then there is Bit Digital. This was a Bitcoin mining company. Their entire business was Bitcoin. They just announced that they're doing a full pivot. They are selling their Bitcoin holdings and have already converted them into Ethereum. They just raised another $172 million to buy even more. They now hold over 100,000 Ethereum. Their CEO, Sam Tabor, came right out and said that their mission is to aggressively add more so we become the preeminent Ethereum holding company in the world. There is no second best, they said. And to complete the trifecta, another company, Bit Mine Immersion Technologies. You probably heard of Tom Lee, right? They just announced a $250 million private placement. And what's the purpose? To implement an Ethereum treasury strategy. The deal was led by a host of big names, and the new chairman of their board is Tom Lee, the founder of Fundstrat, a major Wall Street strategist. You add it all up. And just between these three companies, we're talking about an acquisition of nearly 400,000 Ethereum from the open market in a matter of weeks. This is not a trickle. It's a fire hose aimed directly at the available supply of Ethereum. So the question is, why? Why this sudden aggressive shift, and why Ethereum specifically? This is not the digital gold argument. This is the digital infrastructure argument. The people running these companies are not just saying they think the price of Ethereum will go up. They're saying, and I'm quoting here, that Ethereum can rewrite the entire financial system. That Ethereum is a foundational layer for global finance. They are not buying a hedge. They are buying economic infrastructure. They are buying a productive asset. And this is the most important distinction. When you hold Bitcoin in a corporate treasury, it just sits there. It has no native yield. It produces nothing. But when you hold Ethereum, you can put it to work. The primary way you do that is through staking. You take your ETH, you lock it up in the protocol, and you use it as economic weight to help validate transactions and secure the network. And in exchange for providing that economic security, the network pays you a yield in Ethereum. These companies are not just talking about it. They are doing it. SharpLink has already deployed 100% of its reserves into staking solutions, and it is already generating staking rewards. Think about that from a corporate financial perspective. Your primary reserve asset is not just a hedge, it is active yield generating instrument. Your treasury is no longer just a cost center, it's a profit center. It is earning you more of the underlying asset every single day just for helping to run the network. That is a paradigm shift, and it goes deeper. Tom Lee put it perfectly. He said, stablecoins have become the ChatGPT of crypto. They are the killer app. And where do the vast majority of those stablecoin payments get transacted? On Ethereum. So by holding and staking Ethereum, these companies are not just bidding on an asset. They are buying a piece of the railroad itself. If they own a stake in the infrastructure that will power the tokenized dollars of the future, they get a cut of every transaction. Now, all of this sounds incredibly bullish, and it is. But as a security engineer, my brain is wired a little differently. When I see a massive opportunity, the first thing I do is I threat model it. I don't just see the upside, I see the attack surface. And let me tell you, what these companies are doing is both a security engineer's dream and an absolute nightmare. So let's put on our black hats for a minute and walk through the gauntlet of risks these companies are willingly taking on. First, let's talk about custody. This is the most basic and most terrifying problem. We're talking about companies holding $500 million worth of the digital bearer asset. How are they securing it? Where are the keys? It's not like a bank vault, a single compromised laptop, a single successful phishing attack on a key executive, a single disgruntled insider, and it could all be gone forever. There is no one to call. There are no chargebacks. The articles mentioned they are using institutional grade custody partners like BitGo and Fidelity Digital, which is the right and only sane move, but that just shifts the trust. You're still relying on a complex system of multi-signature wallets, hardware security modules, and strict human processes to protect those assets. The security required to do this is at the scale is monumental. It's a 24/7, 365 battle against every hacker on the planet. Second, smart contract risk. This is the big one for me. They have explicitly said that they are participating in staking and DeFi mechanisms. That means their treasury, their $500 million treasury, is directly interacting with smart contracts. And what do we know about code? It has bugs. Every time they deposit their Ethereum into a liquid staking protocol or a yield strategy, they're placing the full faith and credit of their company on the quality of code that was likely written by a team of anonymous developers. What is their process for auditing this code? As a security engineer, this is what keeps me up at night. Do we have teams dedicated to formal verification? Are they running their own nodes to verify every transaction, every state change before they commit capital? Or are they just aping into the same protocols as everyone else? The security of the entire company now depends on their ability to assess smart contract risk. That is massive and terrifying new responsibility for a publicly traded company. Third, there's operational security and slashing. When you stake Ethereum, you run validators. If your validators go offline because your data center has a power outage, or if you accidentally misconfigure them and they sign two different blocks at the same time, their Ethereum protocol itself will punish you. It is called slashing. The network will automatically burn a portion of your stake ETH as a penalty. This is not a hacker you have to worry about. It's the network's own automated immune system. It means these companies need flawless operational security. Redundant systems, backup power, fail-over internet connections. The OPSEC challenge is immense. And finally, that's the compliance gauntlet. These are public companies. They answer to the SEC. They have to file quarterly reports and disclose every material risk to their business. Navigating the regulatory landscape of crypto, especially when you are actively using it for yield generation, is a minefield. This is a battle fought in boardrooms and with armies of lawyers, not just with code. Now, I'm not saying this to be negative. It's quite the opposite. The fact that these companies, with their boards of directors and the SEC filings, have looked at all these risks, custody risk, the smart contract risk, the slashing risk, the regulatory risk, and have decided to proceed anyway is the most powerful vote of confidence you could possibly imagine. They have done the due diligence, we hope. They have looked into the abyss of what it takes to secure assets on chain, and they have concluded that the opportunity is so great it is worth it. Damn right. They believe in the fundamental security and reliability of the Ethereum network. So what happens next? What are the second-order effects of this trend? First, we have a classic supply shock. In my opinion, hundreds of thousands and soon likely millions of Ethereum are being pulled off the global market and locked into staking contracts. This is the most diamond-headed holding you can imagine. This Ethereum is not on an exchange waiting to be panic sold. It's secure in the network. As this trend continues, the liquid available supply of Ethereum will continue to trend. At the exact moment, demand from institutions is starting to explode. You do not need a PhD in economics to figure out what that does to a price chart. Second, this provides a blueprint for all of TradFi. This is not a one-off. It's a playbook. We just saw Robinhood do something similar, building their own controlled layer 2 on top of Ethereum to manage compliance and MEV, maximum extractable value. It's the same story playing out at different scales. TradFi giants and agile public companies are all arriving at the same conclusion. Ethereum is the foundation you build on. This is the ultimate validation. It is not crypto people convincing themselves Ethereum is valuable. It's Wall Street and public companies making multi-$100 million bets that this is the future of financial infrastructure. They're not just buying into Ethereum of today, but the promise of what's coming with upgrades like Fusaka, which will make this infrastructure even more powerful. The era of corporations treating crypto as a speculative sideshow is ending. The era of them integrating it into the very core of their financial operations is beginning. They are choosing Ethereum, not just for its potential appreciation, but for its utility, its yield, and its foundational role in the new economy. They are becoming active participants, securing the network, and taking on all the security risks that come with it. This is the moment that Ethereum becomes reality. The moment Ethereum stops being a promising technology and starts being the settlement layer for serious global business. And we are all here right now watching it happen in real time. This is a signal. Pay attention. Thank you. So if you enjoyed that, please like and subscribe, and it keeps me motivated to keep on doing more of these. And if you want to contribute to my Ethereum buying fund, just like donate me through PayPal, and just write a comment on like what video you would like to see me talk about next. So yeah, so thanks everybody for tuning in, and peace out.